Okay, folks. Today we are moving into a new topic called Monetary Policy Part 1, which I'm just going to label as Operating Procedures. Next week, we will move on to the second part of this series called Implementation Challenges. I'll get into all of that later on, though. Okay, so like I said in my email, I think that the content that is in this section of the course is probably the most important, in my opinion, for the entire semester. If there's really one thing I want you guys to remember long term, it's the information that's in this section. We are really now going to kind of dig deep into exactly how it is the Federal Reserve kind of conducts and implements monetary policy. In your intermediate macro class, the extent of discussing monetary policy was probably things like the Fed or the central bank changes the money supply, or maybe even a central bank changes the interest rate. Well, we're gonna go much further into it and talk about specifically the operating procedures that the Federal Reserve implements and practices in order to carry out these very important monetary policy actions, all right? So I gotta warn you that a lot of this stuff is really technical, okay? It's not difficult mathematics. We're just gonna basically be looking at an application of supply and demand in a particular type of market that the Fed influences greatly. But the language, the concepts, the definitions are a bit obscure to 99.9% of the population, okay? So I'm gonna go through this kind of slowly and systematically. And please, if any of this stuff is confusing, I want you guys to raise your hand and stop me as we're going through this, and I'll try to explain it a little bit more clearly. And that also goes for all you folks who are tuning in remotely as well. Okay, any questions then before we get started? Are we good? Okay. Buckle up. You ready? All right. To try to kind of segue this over from the last section of the course where we talked about the money supply process, I think we're now at a point in the semester where we're ready to examine in much greater detail the various instruments, or sometimes I'll call them tools, of monetary policy that the Fed has at its disposal to try to influence things like interest rates and even broader monetary conditions. So things like M1 and M2 money supply. How is it that they influence those conditions through the specific tools that the Fed, or instruments that the Fed has? Because the Fed's use of these instruments, I think, has a big impact on the overall economy, on levels of economic activity, it's important to see how the Fed uses them in practice, and also how the Fed's use of all of these instruments has changed over time. That's another big point, right? How the Fed actually conducts monetary policy has changed dramatically in just the past 10 years or so, all right? We're going to talk about that evolution and specifically what the Fed is doing today in contrast to how the Fed was behaving in years past. Okay, so for a long time now, the Fed has focused its discussions of monetary policy on a particular interest rate called the federal funds rate. The federal funds rate has become indeed the primary policy instrument of the Fed. All right, now let me stop there. How many of you guys, just by a show of hands, have heard of the federal funds rate? What is the federal funds rate? So there's lots of interest rates in our economy, okay? The federal funds rate is an interest rate on a particular financial instrument. What is that? Any of you guys know what the federal funds rate is? Levi, is that right? Derek, not even close, okay? Go ahead. It's the interest rate that banks charge each other on overnight loans of bank reserves. Right? Now, we will get into much more detail about that particular market, but suffice it to say that there is an interbank market from one commercial bank to another or one financial institution to another for overnight loans of reserve balances, okay? In other words, I say overnight because they're extremely short-term loans. They're given one day and they're literally paid back with interest on the next business day, all right? The interest rate between those two parties is determined bilaterally, and that is the federal funds rate. So it is not an interest rate that is set by dictate by the Federal Reserve. The Federal Reserve tries to target or manipulate the federal funds rate, but in fact, the funds rate is an interest rate that's determined in this interbank market, okay? That's what I mean by the federal funds rate. So, by the way, when I talk about federal funds, I'm talking about overnight bank reserves. I'm going to use these concepts kind of interchangeably throughout the discussion. So if you hear me talking about commercial bank reserves or the interbank market or federal funds, those all essentially mean the same thing, all right? And the interest rate on those assets is the federal funds rate. Okay, since 1994, the Fed has actually announced a specific target for the federal funds rate after every one of its FOMC meetings, okay? So to fully understand how the Fed actually implements monetary policy in practice, we really have to understand how it affects the federal funds rate and how its actions are aimed at getting the funds rate as close to the target as possible. The FOMC announces a target for the federal funds rate. It then takes certain actions to try to bring that market rate as close to its announced target as possible. So discussions about the money supply now are no longer going to be sufficient when we talk about real-world monetary policy conduct. We really have to talk about what the Fed is doing to influence the federal funds rate in particular. Okay, here is an outline of how this class is going to go for today and really the next class as well. Excuse me. The first thing we're going to do is we're going to start by reviewing some of the various tools and facilities, let's say, that the Fed has in order to influence the federal funds rate. So there's actually lots of things that the Fed has in its tool belt to influence the level of the funds rate in this interbank market. We're going to, some of these tools you've already heard of, you're aware of. Some of them are fairly new and that have been innovated in recent years that we'll need to discuss a little bit. The second part of the talk today, and really the most important, is that we're going to try to explain how the Fed targets the funds rate by appealing to a particular model. It's going to be a supply and demand model for these overnight bank reserves in this interbank market, okay? We're going to use that supply and demand model to demonstrate how the Fed can use its tools. So one of those tools is something like an open market operation in order to achieve a desired target level for the federal funds rate. Now, the particular operating procedure that the Fed used for a long time up until the financial crisis, which you guys may remember from about 10 years ago, so this was between 2008 and 2009, was what has been called subsequently a corridor system, all right? So here I'm going to start introducing some language that you may not be familiar with. So this supply and demand model of interbank loans that we're going to develop, we're going to use this to describe how the Fed can implement policy in what's called a corridor system. I'll talk about specifically what I mean by a corridor system in a few minutes, but just bear in mind that this operating procedure or system, if you will, or way of implementing monetary policy was the way things were done before 2009. That is up until late 2008, actually, okay? After the financial crisis, the Fed engaged in a lot of different activities that affected the size of its balance sheet that caused it to have to move away from a corridor system to a very different type of operating system that we'll talk about on Wednesday, and that's what's called a floor system. All right, so one question you may already be asking in your minds is, well, Givens, why are we wasting our time talking about a corridor system if that's not actually how the Fed behaves today? Well, the reason is because to really understand how the Fed operates today in what's called a floor system, we need to develop this supply and demand model for bank reserves in a corridor system. And in fact, there are elements of the corridor system that are coming back into play in recent years. Okay, I'll get more into this next week, but there are certain limitations or challenges that the Fed faces in trying to implement policy through a floor system. All right, so that's one of the big things this week, is understanding the difference between a corridor versus a floor operating system for the Fed. 3.2 was pre-2008. Post-financial crisis, we've been in this floor system. Really important stuff. Okay, the last thing we'll do is, and this is pretty straightforward, we're going to discuss how various policy tools are actually implemented in practice. We're going to focus on two: open market operations and discount lending. So up till this point, we've basically just said that the Fed buys or sells assets as an open market operation. Well, how exactly does that play out? What component of the Federal Reserve is responsible for doing that? Who do they deal with? You know, what are the specific instructions? We'll go through that probably the end of class on Wednesday. Okay, any questions so far? Again, please stop me if any of this stuff is confusing. I want to try to present it as clear as humanly possible. Okay, before the financial crisis of 2007 to 2009, really, the Fed relied on just three types of policy tools, okay? One of those tools you're already familiar with, that's called open market operations. A second tool was discount policy. We've also talked about that to some extent. And the third is reserve requirements, which incidentally have changed in just recent months. During and after the financial crisis, however, the Fed announced several new types of tools or facilities that it used to affect monetary policy. Now, a lot of those tools they no longer use, but actually two of them are still in use today that we're going to talk about on the next slide. One of them is enormously important to this floor system, okay? All right, the first policy tool that I want to review are these things called open market operations. Now let's be real clear about what we mean by this, okay? What is the actual definition of an open market operation? That's the Fed's purchases or sales of securities, usually treasury securities, of different maturities, short-term treasury bills or longer-term treasury bonds in secondary financial markets. Now, I think I've touched on this before, but what do we mean here by secondary financial markets instead of primary financial market? An open market operation is the purchase or sale of treasuries by the Fed in secondary market. What markets are those in particular? And how are they different from primary financial markets? Go ahead, speak up. Yes. When the Treasury Department first issues bonds or bills in what's called a Treasury auction, that's a primary market. But let's say you purchase those bills in a primary market. The very next day, you could turn around and sell those to another investor in these secondary markets. These secondary market transactions are enormous compared to the primary market ones. It's the Fed's actions in these secondary markets that are called open market operations. The Fed does not buy treasuries directly from the Treasury, right? It buys T-bills from other private investors, big banks, these primary securities dealers. Now, look, traditionally, the Fed concentrated its open market operations on 3-month Treasury bills, that is short maturity Treasury debt. And the goal was always to influence the amount of bank reserves in the banking system, as well as short-term market interest rates. After the financial crisis, open market operations started to be expanded to a larger array of assets, things like mortgage-backed securities, longer-term treasury debt, et cetera, et cetera. But originally, it was just focused mostly on short-term treasury. Okay? The second one is discount policy. Now, again, what is the actual definition of discount policy? This is the tool of setting the discount rate. The Board of Governors sets the discount rate as well as the terms of discount lending. Right? Now, you guys remember hopefully from our discussion earlier in the semester, when Congress first passed the Federal Reserve Act of 1913, it envisioned for discount policy to be the primary tool of the Federal Reserve, right? It was to be the mechanism whereby the central bank, the Federal Reserve, could provide emergency liquidity to commercial banks. The channel whereby that lending takes place, of course, is called the discount window. It's the means by which the Fed makes discount loans to banks. The district Federal Reserve banks are the ones that make these loans to member banks in each district, right? This was to serve as the main channel for meeting the liquidity needs then of private banks. That's the second tool of monetary policy. Of course, today, discount policy is nowhere near as important or as frequently used as things like open market operations. Reserve requirements. Let's be clear about what these are. Reserve requirements are the regulation handed down by the Board of Governors to banks to require them to hold a fraction of their checkable deposits either as vault cash or most likely on their reserve account balances or deposits with the Fed. Okay. Reserve requirements have an impact on the money supply through the money multiplier, right? If required reserves go up, what happens to the money multiplier? It goes down. That's a term that, remember, is in the denominator of the money multiplier. So changes in reserve requirements is going to affect the money multiplier and therefore affect the supply of money in the economy. Now, I talk about reserve requirements. The truth, reserve requirements for a long time didn't change. But this year, actually March 15th, 2020, the Fed actually lowered reserve requirements to 0%, okay? The reserve requirements were kind of on this tiered system where the first, few $1 million of a bank's deposits, the reserve requirements were maybe like 3%, and then once you got to a certain threshold of deposits, your reserve requirements were like 10%. As part of the floor system of setting monetary policy, certain things have happened in the banking system that no longer require the Fed to mandate these reserve requirements, because it turns out that banks are holding an enormous amount of excess reserves anyway. So the formal reserve requirement has actually been lowered to 0% real recently. Now, next week, we're going to talk about some other types of informal reserve requirements that are still incentivizing banks to hold on to large amounts of excess reserves. So even though reserve requirements are technically zero, there are actually other regulations that banks have to follow where the end result is they want to hold a bunch of liquid assets. And one of the most liquid assets that a bank can hold are, of course, reserve balances at the Fed. Okay, during the financial crisis, the Fed introduced two new policy tools that are connected to bank reserves that are still in use today. One of them is interest on reserve balances. This one is enormously important to the conduct of policy today. You must understand this policy tool. Okay. 15 years ago, no one talked about interest on reserves in a monetary policy class because it didn't exist, okay? It does now and has a huge impact on the way the Fed conducts its business. In October of 2008, the Fed began for the first time, so this was right when the financial crisis was heating up, to pay interest on banks' required and excess reserves on both of them. So even though the interest rate is called the interest rate on excess reserves, they actually do pay it on both required and excess reserves, even though required reserves are now zero. Okay, now let me ask you this question about interest on reserves and how this is related to required reserves. Back when the Fed had a required reserve regulation, banks would argue that the Fed's required reserves would act like an implicit or a hidden tax on them. Let me ask you that question. Why or in what sense are reserve requirements an implicit tax on banks? Yes, back row there, go ahead. Yes, required reserves come with kind of an opportunity cost, right? If the Fed is requiring a bank to hold 10% of its deposits as reserves, that's funds that the bank cannot loan out to another investor, or that's funds that banks can't use to purchase another asset that can earn them a higher return. And so that's the sense in which reserve requirements acted as an implicit tax on banks. Banks were often complaining about this because the implicit tax in some cases can be large. All right, these banks could otherwise receive interest on the funds that they could lend out to other investors. Now, let me tie this back to interest on reserve balances. The Fed can reduce the implicit tax on required reserves by paying interest on reserve balances, right? If the Fed is now willing to pay even a small interest rate on banks' holdings of reserves with the Fed, then that opportunity cost of holding reserves is going to shrink, right? So this was one benefit of the interest on reserves policy, was that it actually lowered that implicit tax that banks faced on their holdings of excess reserves. Now, how can the Fed influence the amount of reserves in the banking system? Through this interest rate. By the way, I didn't mention this. The interest rate on reserve balances is not a market interest rate. It is a rate that is set administratively by the Fed. The Fed just announces what it's going to be, right? So if the Fed wanted to increase bank reserves in the banking system, what they could do is they could raise the interest rate on reserve balances. And that would encourage more banks to hold more of their assets in the form of reserves, right? Lowering the interest rate on reserve balances would discourage banks from holding a large quantity of excess reserves. That would impact then the total money supply through the money multiplier. The last policy tool I want to just really briefly talk about here is something called the term deposit facility. So in April of 2010, the Fed started offering something called term deposits. Now, term deposits, you can think of these as something that's very similar to like a bank CD for a retail customer, right? If you were to go to a bank and purchase a CD, you lock up your money in that asset for a fixed period of time. For instance, you might buy a 6-month CD or a 1-year CD, or maybe even a 5-year CD. The longer the maturity, the higher the interest rate you get. Well, term deposits are just like that, except the Fed is offering these to commercial banks, okay? And so what the Fed would do is they would offer these term deposits in periodic auctions, and the interest rates that were determined in those auctions usually would settle somewhere above the interest rate on reserve balances, but pretty close to those. Now, how is it that the Fed can influence the quantity of reserves in the banking system through this term deposit facility? Well, not to get too technical, but essentially what happens here is if a bank buys one of these term deposits. It places its funds in a term deposit. Those funds are then removed from the reserve account of the bank or the participating institution for the life of the term deposit. And thereby they drain reserve balances from the banking system, right? If you go to a bank and buy a CD, let's say a 1-year CD, you're going to move money from your checking account over to the CD. That's going to drain resources from your checking account for that 1-year period, right? So this facility gave the Fed another tool whereby it can affect the amount of bank reserves in the economy. The more of these term deposits that it offered, the more it could drain bank reserves from the banking system, all right? In fact, I went and checked on the data on this just yesterday, and the last term deposit facility they offered, I believe, was late last summer. So in fact, this one looks to be like it's expiring, and it may not be used much longer. So when I teach this class again next year, I might have to ignore this one altogether. Okay, so those are the 5 tools of policy: open market operation, discount window lending, reserve requirements, and the 2 new tools are interest on reserve balances. That's the most important one. And then also this term deposit facility. Both of these new instruments of the Federal Reserve help the Fed control the amount of reserves that are in the banking system. That's important to this interbank market that we're going to talk about here in just a minute. Okay, how are we doing so far? Is all this clear enough? I promise I'm doing my best to try to explain it as clearly as possible. By the way, one other thing I failed to mention. There is really not a good undergraduate textbook that describes this type of material. Because the Fed has been innovating so quickly in recent years, the textbooks have largely failed to keep up with what's happening. Some of the textbooks touch on some of these topics a little bit, but they don't go into as near enough detail as I think is necessary for this course. So the readings that are attached for this section are really important, and most of them are these articles that have been published by various Federal Reserve district banks. So they're written clearly and at a level that, you know, an undergrad econ major should be able to understand. So I would really encourage you guys to go through and try to read those articles as background reading or provide more context on what we're talking about. And I can only put so much detail in the slides before it just becomes kind of unmanageable, all right? So I would really encourage you guys to go take a look at those readings. In fact, I'm going to post a few more that I've just found in recent weeks to Blackboard later this week. Okay. Since 1994, the Fed's standard operating procedure has been to set a target for the federal funds rate. Now, we talked about this at the beginning of the class today, but just again to be clear, the federal funds rate is the interest rate that banks charge each other on these overnight loans of reserves in order for banks to meet their reserve requirements and any other kind of temporary liquidity needs. Now, let me set this up and describe how this actually works in practice, okay? You've got thousands of commercial banks in the economy, okay? Every single day, people are making deposits at these banks. Some people are making withdrawals. Banks have different fees they have to pay. Other people are paying the bank. Those payments have to be processed in real time. What happens is at the end of every business day, because of idiosyncrasies between one bank and the next, some banks are going to find themselves in a position where they're short of reserves in order to meet the reserve requirements or other types of liquidity needs that they might have, okay? There are going to be other banks in the whole banking system that actually at the end of the day might find that they have more reserves that they need in order to meet these goals. This is how this interbank market emerged, right? Where this type of scenario is what allows one bank to borrow and lend from another bank, okay, in this thing called the federal funds market. Now, I put in bold letters here that these overnight loans are unsecured. That's an important term. Unfortunately, I don't really describe it in detail in the slide, so let's talk about that for a minute. What do we mean by unsecured loan? That's important to understand. In the interbank market for reserves, when one bank borrows from another, these loans are unsecured. What's the difference between a secured loan and an unsecured loan? Yeah. Sorry? Yes. A secured loan, when you're borrowing, you have to post collateral so that in case you default, whoever is loaning you those funds can obtain that collateral, right? It helps reduce the risk that is exposed to the lender, the one providing credit, okay? This interbank market for federal funds is an unsecured market. So banks that are obtaining overnight financing don't need to post any collateral in order to do that, okay? What that means then is that, let's say I'm a bank. What's your name again? Santiago. Let's say that you are trying to borrow money overnight from my bank, okay? How the federal funds rate is determined is through a bilateral transaction. I'm going to charge you an interest rate on that loan overnight. That's the federal funds rate. When I decide what interest rate I'm going to offer you, I have to take into account what's called counterparty risk, right? What's the likelihood that you might not be able to pay that back because the loan is unsecured, okay? Now, it turns out that the overnight market is highly competitive. So if I offer you an interest rate, a Fed funds rate that's wildly different than what you could get elsewhere, you'll simply take your business elsewhere. So it turns out that the interest rates between banks are really similar across the whole market. What the Fed actually tries to do is target what's known as the effective federal funds rate, which is a weighted average of the interest rates between all these bilateral parties throughout the trading day. What's your question, Santiago? Yes. Well, no, it's determined bilaterally, meaning that you and I are going to agree to an interest rate. That's the federal funds rate. Overall, now, let me get into this into the second. How can you update it? That's right. So if you, let's say you come to me requesting an overnight loan, I might say, okay, I'm going to charge you an interest rate of 1%. You might say, well, how about 0.8%? We might agree to 0.9%. The job of the Fed is more or less to try to ensure that the effective federal funds rate, which is a weighted average of all of those interest rates in the economy, is somewhere close to its target, which I'll get into. And that's the point I want to raise here in this second point in the slides, is that although a federal funds rate target is established by the FOMC, the FOMC might come out and say, we want to target a funds rate of 2%. The actual rate is determined, Santiago, by supply and demand conditions in the market for reserves, that is, in the Fed funds market, okay? So we're going to determine our interest rate bilaterally, but because the market is very competitive, overall supply and demand conditions are going to determine what interest rate I'm ultimately really going to be able to charge you, right? Think of it like a perfectly competitive market where the seller has to basically set the price at whatever the market prevailing price is. That's an important point that I want you guys to remember, is that the federal funds rate is a market interest rate, unlike the interest rate on reserve balances, which is an administrative rate. Nevertheless, the Fed tries to target it by affecting the amount of bank reserves that are in the banking system. Okay, so if the funds rate is determined by supply and demand conditions in the banking system, that is for overall bank reserves, then if we really want to understand what affects the federal funds rate, What we have to do is look at the actual demand and supply for bank reserves system-wide. And that's what we're going to talk about for the rest of class today. Let's focus on demand first, okay? Now again, why is it that banks demand bank reserves or reserve balances? Well, for two reasons. One, they have to meet legal obligations to hold required reserves against their deposits, okay? Now, although required reserves are technically now zero, like I said earlier, there are other regulations, in particular certain capital requirements that banks have to abide by that generate a demand for bank reserves. So that's where part of the demand comes from. The other part of the demand comes from banks' desire to hold excess reserve. Banks can never predict perfectly how much liquidity they're going to need on any given day. A lot of people could make withdrawals. And so the bank's demand for excess reserves to meet these liquidity needs also drives the system-wide demand for reserve balances. Okay, now here's the important kind of theoretical point I want you to think about. What we're going to talk about for the next few minutes is the relationship between banks' demand for reserves and the federal funds rate. That demand curve should be downward sloping, like any regular demand curve that you see in economics, okay? Now, why is that? Let's think carefully about this. Let's suppose that the federal funds rate starts to increase. Santiago, if you are a bank that is thinking about borrowing in the interbank market, all right, on the margin, you're thinking about perhaps taking a loan from another bank. If you see that the federal funds rate is rising, what does that do to your cost of borrowing? Your cost of borrowing goes up if the interest rate on those loans rises. So as the federal funds rate goes up, you start to be discouraged, or your incentive to want to borrow in the federal funds market is going to go down. You're going to want to borrow fewer federal funds or overnight loans of bank reserves, okay? Jameson, let's say Jameson is thinking about lending in the federal funds market. Jameson, if you see that the funds rate is going up, how does that affect your behavior as a lender? You're even more desirous to lend. Why? Because if you hold on to those excess reserves, then you're facing a higher opportunity cost. As the funds rate goes up, you could make more money by lending. So what do we have here? Both the borrowing banks and the lending banks want to get rid of bank reserves when the funds rate rises. So the entire system-wide demand for bank reserves goes down as the federal funds rate goes up. By contrast, as the federal funds rate declines, the demand for bank reserves in the entire banking system is going to go up for exactly the opposite reason. Because now, Santiago, the cost of borrowing goes down, and Jameson, as a potential lending bank, you're starting to become more indifferent between loaning your bank reserves or not, because the opportunity cost of holding them is smaller, right? So overall in the banking system, there's going to be a larger demand for bank reserves as the funds rate falls. In other words, what we've described here is a downward sloping demand curve for bank reserves in the federal funds rate. As the funds rate rises, the quantity demanded of bank reserves system-wide goes down, and vice versa. In principles, when we talk about why the demand curve slopes down, we use this phrase, all else constant, right? Ceteris paribus, that's the Latin phrase for it. Well, there's lots of other things that could happen in the financial system that could cause the demand for bank reserves to shift around, right? Other market interest rates, the required reserve ratio, et cetera. If we hold all of those other factors fixed, then what we should see is that as the federal funds rate goes up, the demand for bank reserves falls. As the funds rate declines, the demand should increase. There's a downward sloping demand curve. Okay? How about the supply? So we've established that there should be a negative or downward sloping relationship between the funds rate and the demand for bank reserves. What about the relationship between the funds rate and the supply of bank reserves? Okay, system-wide, who is it that ultimately supplies bank reserves to the US economy? There is one institution that is effectively a monopoly supplier of bank reserves, and that is the Federal Reserve System, okay? In our supply and demand model, the Fed is going to be our supplier of bank reserves, all right? Now, the Fed can supply bank reserves to the banking system in one of two ways. Either by providing bank reserves to banks in the form of discount loans, right? We call those borrowed reserves because banks are borrowing the reserves from the Fed temporarily. More importantly, though, the Fed can supply reserves to the banking system through open market operation. We call those non-borrowed reserves. Why? Because when a bank acquires reserves in that way, it's not taking out a loan, rather it's basically selling an asset to the Fed. The Fed is paying the bank for that asset by crediting its reserve account with more commercial bank reserves or reserve balances. Those are non-borrowed reserves. The Fed can affect the total size of bank reserves in the economy through borrowed and non-borrowed reserves. Okay, now here is the key question I want you to think about. Would the supply of reserves by the Fed be influenced in any way by the federal funds rate? Or alternatively, should the Fed be able to set the amount of reserves in the banking system independent of what the federal funds rate is? That is this interbank interest rate. This is going to have a big impact on the shape of the supply curve. The Fed can effectively control the total amount of bank reserves in the banking system through open market operation, right? It doesn't matter if the federal funds rate is high or low. If the Fed wants to increase bank reserves, it simply does what? It buys assets from banks, thereby injecting reserves into the banking system. If it wants to drain reserves from the banking system, it does the exact opposite. It sells assets off of its balance sheet. Now, the Fed can't compel banks to borrow from it through the discount window, so it doesn't have perfect control of borrowed reserves, but the Fed can perfectly control non-borrowed reserves through open market operation. So the point here, and I know this is not easy stuff to understand, but the Fed can actually set bank reserves system-wide at any level it desires, irrespective of what the federal funds rate is. Which means what that's going to have, that means that the supply of bank reserves is going to have a special shape to it. The demand for bank reserves is downward sloping. But if the Fed can affect the supply of reserves at irrespective of what the funds rate is, that means the supply of reserves is going to be perfectly vertical, right? So whereas your standard supply-demand model has an upward sloping supply, in this model of bank reserves, the supply curve is going to have a vertical component to it. That's really important. This one here just sums up basically what I just said. Through these open market operations, the Fed can basically set bank reserves at whatever level it wants to meet its objective. And that is by adjusting non-borrowed reserves through open market operations. So the quantity of reserves supplied in this model doesn't depend directly on the particular value of the funds rate. Okay, questions so far? Surely someone has a question. let's put this together now in our model so that we can explain what the hell a corridor system is, okay? And this will set the stage for us to understand how the Fed actually uses a floor system in the next class. Okay, let's look at the demand curve first. So we're going to place the supply and demand curve on the same graph here, the same set of axes. So here's how you guys are going to need to do this. On the horizontal axis, we have the quantity of the good that we're trying to model. Those are commercial reserve balances, right? Bank reserves. The vertical axis on a supply-demand model, of course, has the price of what we're talking about. The price of overnight loans of reserves is the federal funds rate. I'm going to denote that interest rate I subscript double F. There's different interest rates that are important in this market. So IFF is the federal funds rate, all right? The demand curve is this blue line here that slopes down for the two reasons that we talked about a few minutes ago, right? As the funds rate falls, banks that are thinking about borrowing in the interbank market are more encouraged to do so because the cost of borrowing goes down. So the demand for bank reserves increases. Banks that are thinking about lending in the funds market, however, are kind of discouraged from lending. Why? Because the opportunity cost of just holding on to those excess reserves is going down. So their demand for holding on to bank reserves goes up as well. That causes the demand curve to slope down. Okay. Now, you might be looking at this graph and wondering why the hell I have drawn it with this perfectly flat or perfectly elastic component. Now, you'll notice on this graph that the demand curve for bank reserves becomes perfectly elastic or horizontal at the IRB rate. So I sub RB is the interest rate on reserve balances. Again, this is not a market interest rate. This is the interest rate that the Fed sets administratively on reserve balances. It's the interest rate that banks get on their holdings at the Fed. Now let's think about this for a second. This is a critical part of the analysis. Why do you think the demand for bank reserve system-wide is perfectly flat once we get to the interest rate on reserve balances? In other words, why can't the funds rate go below the IRB rate? Yes. What's your name? Levi. Yes. Okay. Go ahead. Great. That's a perfect answer. What bank is going to want to lend to another bank in this overnight market at an interest rate that is below what that bank could get simply by parking those reserves at the Fed? Makes no sense, right? So in theory, the funds rate should never be below the interest rate on reserve balances. Levi, that's a great answer. There's another one that I actually think is helpful for what we're going to do next week, and that is one that's based on an arbitrage argument. You guys heard of that word before, arbitrage? Okay, let's pretend, Levi, for just a moment, that the funds rate actually is below the interest rate on reserve balances. If that were true, then what would banks have an incentive to do? Borrow in the overnight market, let's say at an interest rate of 1%, and then simply park those funds with the Federal Reserve at an interest rate of 1.25%. You could earn 25 basis points risk-free by borrowing from this guy and putting your money in this account. Well, Levi, you're not the only smart guy in town, right? Lots of banks are going to try to play that exact same game. And the more they borrow in the interbank market, what happens to the federal funds rate? It goes up, right? And what will happen is the funds rate will equalize the interest rate on reserve balances because of this arbitrage activity, okay? Either of those two explanations is why the demand curve is flat down there at the interest rate on reserve balances. Okay, let's take a look at the supply curve. As I indicated on the previous slide, we see that the supply of bank reserves is perfectly vertical at the level of reserves that the Fed wants to target, let's say. Let's say the Fed wants to have an amount of reserves in the banking system equal to R star. Through open market operations, that is through non-borrowed reserves, it can either buy or sell securities in such a way to guarantee that the amount of bank reserves system-wide is exactly equal to R star, irrespective of what the federal funds rate is. So the supply curve is perfectly vertical at the position that the Fed desires. Now, there's something funny about this supply curve too that I haven't talked about. You'll notice that it has this perfectly elastic component up here at the top. And that flat portion of the supply curve occurs exactly at this interest rate I sub B. What interest rate is that? That's the discount rate. This is the interest rate on reserve balances. This is the discount rate. The discount rate, again, is an administrative rate set by the Board of Governors. It's not a market-determined rate. Now, let's talk about this for a minute. Why is the supply curve perfectly elastic at the discount rate? In other words, why is it impossible or unlikely for the federal funds rate to exceed the discount rate? Why would we not see that in the real world? Levi? What bank is going to want to borrow in the overnight interbank market at a rate that exceeds the rate that it could get by borrowing directly from the Fed? Now, Levi, it turns out there are certain stigmas attached to borrowing from the Fed. If you borrow from the Fed and other banks find out, they think that your bank may be in trouble, okay? So in practice, banks try to avoid doing that. But what that means is there shouldn't be a big gap between the discount rate and the funds rate if the funds rate is high enough. That's a good explanation. There's another one based on arbitrage, right? What if the funds rate were higher than the discount rate? Then what would we tend to see? Banks would borrow money from the Fed at the discount rate and then try to lend in the federal funds market. And the gap between those two interest rates would be profit, right? Well, what would happen if all banks started to do that, borrowing a bunch from the Fed and lending in the funds market? The federal funds rate, as the supply of more lending increased, would fall until it equalized with the discount rate. So there is an arbitrage argument that one can apply that would suggest that the federal funds rate can never be higher than the discount rate. And so what I'm trying to say here is that the interest rate on reserve balances becomes a floor that the funds rate can't go below, and the discount rate is a ceiling above which the federal funds rate cannot rise, okay? That's the sense in which this operating procedure is called a corridor system, because what it suggests is that the federal funds rate that the Fed can try to target is going to be determined by the intersection of the supply of bank reserves with the demand for bank reserves, somewhere between this corridor or channel established by the floor, which is the interest rate on reserve balances, and the ceiling, which is the discount rate. That's why this system has been called a corridor system, okay? Now let me stop there and talk about this a little bit more, because this is the central feature of a corridor system and how monetary policy was actually conducted prior to the financial crisis, okay? Essentially, what the Federal Reserve did was they would announce a target for the federal funds rate, let's say 3%. That's the interest rate that the Fed would like to implement in these overnight lending markets between banks. So what would the Fed do in order to actually implement that target rate? They would undergo open market operations, either by buying or selling treasury securities from private banks in a manner such that the supply of total bank reserves in the entire system would intersect the demand for bank reserves on this downward sloping portion of the demand curve right at whatever the target federal funds rate was. Let's say we'll call it IFF star. So the Fed would have to forecast demand conditions in the banking system, and then they would simply have to move around the supply of bank reserves in a way to hit the desired funds rate target, okay? So, Jameson, if the Fed wanted to increase the funds rate, what does it do in a corridor system? It would shift the supply of bank reserves to the left. And how would it do that in practice? By selling treasury securities in the open market, thereby pulling bank reserves out of the banking system. The supply of reserves would shift to the left just enough to raise the funds rate to whatever the new target is. If it wanted to lower the federal funds rate, it would do exactly the opposite. It would purchase treasury securities in the open market in order to increase the supply of bank reserves so that the intersection would be somewhere lower now. But importantly, this intersection, which determined the federal funds rate in equilibrium, would be somewhere on the downward sloping portion of this demand curve. That's why we describe it as a corridor system, because the target funds rate is somewhere in between this corridor between the interest rate on reserve balances and the interest rate on discount loans. In a floor system, which is what we'll talk about in the next class, the world is very different. In that system, the intersection of the supply and demand curves is way out here on the flat portion of the demand curve. And when that happens, what is the funds rate going to be equal to in equilibrium? Just the interest rate on reserve balances. So it's the floor that determines what the funds rate is in that system, whereas it's the corridor here that determines what the funds rate is in the pre-financial crisis system, pre-2008. Surely someone has a question. There's no way I explained it that perfectly. Maybe I did. Okay. Let me finish class today by going over some important points about a corridor system that you need to know. And I'm going to want you in the next class to contrast these with the points that are going to emerge in a floor system. Okay? One thing that I think is important about a corridor system is that the equilibrium funds rate is going to depend on the exact quantity of reserve balances supplied by the Fed. In this way, a corridor system effectively marries the quantity of money to the interest rate target. So there's really just one policy instrument. When we talk about a floor system, the quantity of money and the interest rate target get a divorce, okay? And there becomes more than one policy instrument. In a corridor system, however, the quantity of money that is bank reserves is very much married or tied to the interest rate target. Let me go back to the graph here to show you why. Think about it. If the Fed were to change the amount of bank reserves in the banking system in a corridor procedure, what happens to the funds rate? It goes up or down. So the funds rate target is tied to a specific quantity of bank reserves given the downward sloping demand curve for bank reserves. That's the sense in which the quantity of money, that is reserve balances in the banking system, is married to the funds rate target. So there's really just one policy instrument. You can't really separate those two. Okay, second point. Because the funds rate is still above the interest rate on reserve balances, there's going to be this incentive to try to economize on reserve holdings. So banks are still going to face an implicit tax on their holdings of reserves anytime the funds rate is higher than the IRB rate, okay? And that implicit tax is just the difference between those two interest rates, okay? Now, what happens in that world? Think about this. If banks are facing this implicit tax on holding excess reserves, then they're going to want to seek ways of getting rid of those reserves by trying to lend those reserves to other financial institutions. The real resources that are spent by banks trying to lend those excess reserves creates a deadweight loss in the economy. It's been described as kind of the hot potato problem, right? You guys ever play that game? Somebody has the hot potato and they try to give it to the next guy, right? The bank, that's kind of what's going on here. Banks are lending out these excess reserves, and you don't want to be the bank that has the excess reserves at the end of the night because you face this implicit tax, okay? The resources that banks spend by trying to get rid of those excess reserves is a deadweight loss, kind of, which is described as this hot potato problem. Here's an important point, really important point. In a corridor system, excess reserves will be scarce at the margin. I use this term over and over again, at the margin. Whenever banks face this implicit tax on their excess reserves, they want to try to get rid of them. So excess reserves then are going to be scarce on the margin. Banks don't want to accumulate large quantities of excess reserve. In a floor system, excess reserves are going to be abundant at the margin. Very different scenario. So in this world, pre-financial crisis, banks don't want to hold a large quantity of excess reserves. They want to hold some to meet their temporary liquidity needs, but they don't want to hold a lot. Last point that's related to this. Because excess reserves are scarce at the margin, and banks are trying to lend their reserves, there is going to be an active interbank market for these overnight commercial reserves. That active interbank market can provide a lot of very useful information about the creditworthiness of counterparties, okay? If there's a bank in the system that's constantly trying to borrow, that sends the signal to the rest of the banking community that perhaps that bank is in trouble. They may not be solvent, right? So that active interbank market provides a lot of useful information about the creditworthiness of these financial market participants. Now, let me show you guys, before you leave today, some actual data that illustrates some of these important points about a corridor system, in particular, points number 3 and 4, okay? So these are key features then of the federal funds market prior to the financial crisis. The first graph here on the left are the total excess reserves of depository institutions in the economy. This is data, by the way, that you looked at on your lab last week, except you looked at it for July 2020. This is data on excess reserves between late 2006, right before the financial crisis started, so about mid-2008. What do you see there? There is this spike in the middle of 2007, but all things considered, excess reserves are fairly scarce on the margin. The excess reserves in the entire economy, in the entire banking system, before the financial crisis was usually less than $2 billion or $2,000 million. That's not a lot, right? Especially compared to the amount of excess reserves that banks have accumulated today, right? That's a fairly small number. In the class tomorrow, I'm going to show you a graph that extends this one on out till the present date. And these wiggles here, you can barely see. They're basically at the zero axis. And excess reserves have exploded, right? So on the margin, excess reserves are pretty scarce pre-crisis. Banks are trying not to accumulate a lot of them. This graph over here is really interesting, okay? It shows that the actual volume of trading in the federal funds market, and I've got this between July of 2006 through the end of 2012. What do you notice?
Before the financial crisis, there's a really active interbank market. Banks are trading with one another. By the way, these are daily values. On any given day, it was not uncommon for $120 billion worth of bank reserves to be swapped between banks, system-wide, okay? What happened after the financial crisis? Banks accumulated enormous amounts of excess reserves and interbank lending shrunk dramatically. By 2012, the amount of actual interbank lending was like $20 billion per day compared to $120, $140 billion per day during the lead up to the financial crisis. So pre-crisis, there's this really active interbank market, which we don't actually see today. There's not a whole lot of bank-to-bank lending in the federal funds market anymore. And that's one of the key features of a floor system, which we'll get into in the next class. This link right here, by the way, takes you to an interesting graphic on the New York Fed's website. It also shows this federal funds lending from the period of 2006 to 2004. But for each one, it actually shows the breakdown of who's doing that lending. So the blue shaded area are domestic standalone banks. This red area are the federal home loan banks. We'll talk about what those guys are next week. They play a big role in how monetary policy is implemented today. The brown region are domestic bank holding companies. Do you guys know the difference between a bank and a bank holding company? I know this is an econ class, but unfortunately, because it's monetary policy, there's a lot of finance-y stuff involved. A bank holding company is like one of these big banks like JP Morgan, Bank of America. They have various subsidiaries that do different things, okay? That's the sense in which it's a bank holding company. One of its subsidiaries might be a retail level bank, right? So all the big Wall Street banks that you hear about, that's this brown region here, domestic bank holding companies. This smaller region, blue region here, are usually smaller standalone banks. And then also foreign banks trade in the federal funds market. That's the green sliver. You'll notice here that in the financial crisis, federal funds market lending went down a lot, okay? And who's doing the bulk of the interbank lending nowadays? It's these federal home loan banks, which we'll get into more next week. But this link is pretty cool because it shows you that breakdown of the federal funds market. Okay, let me map out what we're going to do in the next class. And again, I know I'm going through this pretty meticulously here, but it's important to me that you guys understand all the concepts. So the first part of the class on Wednesday, what we're going to do is we're going to work through several examples of how the Fed conducted policy in the corridor system. I've got like 2 or 3 examples with specific dates on what the Fed did to adjust monetary policy in a corridor system. This will give you a chance to practice using that supply-demand framework to analyze how monetary policy affects the market for bank reserves. Then what we're going to do is we're going to exit that system and we're going to start talking about the floor system, which is the operating procedure that the Fed uses today to conduct monetary policy. It has some really important differences from the corridor system. We'll talk about kind of what changes in the economy took place that caused that transition from a corridor to a floor, and we'll revisit this supply and demand model to see how monetary policy is adjusted in a floor system. I'll just foreshadow some of those results, okay, because it's important to me that you guys understand this. Prior to the crisis, the Fed's main tool for policy was open market operations. That's how it adjusted the federal funds rate. After the crisis, open market operations are no longer very important, if at all. And the chief policy instrument that the Fed uses now is the interest rate on reserve balances. If it wants to raise or lower the federal funds rate, it does so by administratively raising or lowering the interest rate on reserve balances. Open market operations aren't effective anymore because of the abundance of bank reserves in the banking system. We'll talk about all of that and view it again through the lens of this supply and demand model. This conceptual framework that I've introduced today is the key thing that I want you guys to understand and how to analyze monetary policy. I promise you, you're going to see test questions on it. I'll have a lab where you can practice it in detail, but I might ask you questions about how to use it to describe what's happening in a corridor system versus a floor system. Next week, we're going to build on to that floor system with other features, okay? So it all kind of builds on what we talked about today. So please, as we move through this material, do those readings and really make sure you understand this market for bank reserves, where the demand curve comes from, where the supply curves come from, why there are these elastic components to demand and supply, okay? That's what we're going to do in the next class, okay? If there's no questions, we will end it there. See you guys.